Good afternoon, everyone. It's a pleasure to welcome you all for today's webinar on SA 570 Going Concern Revised Standard. It was revised on April 1, 2017. So now also AASB is working on the revised revision of the standard again, as the IAASB has taken the project. We have with us the eminent speaker on the subject, Madam Padma Shri Christo. So, Madam, can you please take up from now? Yeah.
Hi, thank you. Thanks for this opportunity. I'll just share my screen. If you can please confirm that you can see the screen. Yeah.
Yeah, it is visible.
Yeah, great. Thanks to AASB and thanks to everyone for organizing. Yeah, going concern I think is a very important standard in terms of the auditing perspective. Going concern is, if I have to state in one sentence, it is more like a make or break kind of standard, I would say, because if we are continuing with the going concern, then there is a different type of reporting that is required. And if you are not going with the going concern, then I think the reporting perspective completely changes. So I think with that very background, I think, yeah, and I'll also briefly cover the changes that are suggested by AASB. It's in the exposure draft was in the public domain. It is further clarifying the existing standard and putting in use, and the practicality actually is more exposed to in terms of how to actually practically deal with this standard. So beginning with going concern, everyone is dealing with this standard on a daily basis. This is a standard that is largely applicable, or it has to be made applicable to all types of entity, maybe it a smaller entity, bigger entity, large entity, startup. So there are different types of, and there are different scenarios in which the same standard will be looked at from different perspectives, and the interpretations and the analysis and the illustrations that this standard has are very wide and very unique as well. This standard has large applicability in terms of the audit. The basic of the accounting perspective, or the principles that we write in the accounting background and the accounting notes, the first accounting note that we generally write about a company in the notes to account starts with something that says that it's prepared on historical cost basis, or the real or the cost basis, and then it is the accounts are prepared on the basis of assumption that it is a going concern. So that assumption of going concern, how the auditor is testing, is very, very important. There have been a number of reports, a number of orders, or debates on whether it has to be qualification or otherwise. Now, if you look at the standard, which is revised in 17 and which is existing from the last 7-8 years, this has brought in a new perspective of reporting. Earlier, if there was a going concern issue, it used to be reported in emphasis of matter paragraph. If it is qualified, then it would, the report would have been qualified. But now we have a very distinct, place, or a distinct mark for going concern, placement of going concern para, which we generally say call as material uncertainty on going concern. So this will appear if there is a material uncertainty in going concern, or otherwise won't appear in the audit report. So if you look at the latest SA 570, as well as if you look at the SA 705, 700 or 705 illustration, not 700, basically 705, 706 illustrations, the MUGC para is specifically put in there with some illustrations. Even in 570, the placement of the para is very clearly shown, and there is a requirement to actually report going concern if there is an issue in the going concern. So this is the simple table of contents that we are going to look at, and And I think during the course of discussion, if any questions come up to you, or if there is any thoughts that you want to share, so please feel free to put it in the chat box or the Q&A box, as the case may be, and we will be taking up those things specifically at the end of the session. Introduction and scope. Basically, this essay deals with the auditor's responsibility in the audit of financial statements relating to going concern and the implications of the audit report. Now, why is this important? And yes, obviously, the scope and the objective is quite long. It runs into 2 to 3 paragraphs. But then, the very sentence that I have captured over here is important in terms of looking at the going concern from the right perspective. So, first of all, it is the management who has to determine whether the entity is going concern or otherwise. That is the first and the foremost responsibility. And then comes the responsibility of the auditor. So first of all, the management's assessment of going concern. Obviously, when everything is good, then that there is no issue with going concern. So there are indicators of going concern, as we know. And which we will come to it. So, for example, negative net worth is getting eroded, continuous loss making, loss of any major supplier, loss of any major customer, so on and so forth, or some legal or regulatory parameter, or change in the scenario of legal and regulatory applicability, and so on and so forth. The major litigation, a number of examples where it can be going concern issue. So if we know that in the past COVID period, during 2020 to 2022-23 mostly, there was an additional guidance that was issued by various uh, accounting auditing bodies across the world, in terms of in during COVID, how to look at this SA 570 specifically, because there were lots of uncertainties that were involved. There were international borders were closed for certain time, so the travel was restricted. So there were a number of companies which actually came into the came into the purview of no going concern kind of a situation. So this is a continuously debatable and ongoing standard, and it is never easy, or there is no black and white difference between what you can consider and how you can consider, because the standard also tells you that it is indicator of going concern. So when you look at those indicators of going concern, it is ultimately for you to determine whether it is going towards going concern, or it is going towards trouble in the going concern, or no going concern, as the case may be. So when we are talking about the management's assessment of going concern, obviously someone is running the business, and then they will say that they will always argue that my entity is always a going concern. I don't have anything to shut it down. So there are indications, intents that you have to, but then you will have to question that, and then you will have to question the detailing of that as to why this is a going concern. So this standard is all about that very specific aspect of professional judgment, and how do you document that professional judgment. So there are scenarios where it may not be so easy to determine. So there are borderline cases. We gave examples of indicators, but it is possible that not all indicators are present. A few of them are present. Then the biggest thing that you have to do is that exercise professional judgment or professional skepticism. When we talk about professional judgment and professional skepticism, it is all about um, in that given situation, and in given that kind of scenario, what is it? What is the best course of action that you should look at, or you should foresee? And professional skepticism is all about always ask with a questioning mind as to who did it, why they did it, whether it is appropriate. So who, what, when, how. Never take anything at the face value. So these things we have to start with the these things as a bare minimum to actually progress on the SA 570 standard. Another important thing is that the standard, as a part of practice, as well as the part of the standard, going concern, if we look at the SA 315, the risk and control based scenarios, that identification of risk, assessment of risk, SA 315 and SA 330, when we look at those standards, and when we look at the planning stage, like SA 200 series also, and the planning stage, when we look at 300 and 200 series, there one thing that we notice is that at the time of planning itself, we will have to evaluate whether the entity is a going concern. So evaluation of going concern, generally there is a myth that people think that this has to be done only at the end of the audit. It is like from the date of the year end, then you have to look at for 12 months. It is true, but then there is an additional layer that you will have to do if you are doing some audit planning. For example, for larger audits, you may start planning in the month of, if the year end is March, you may start doing the planning from the month of November, December. So it is very important that the going concern is assessed at the time of November, December also, and at the end of the audit, which may be April, May, because it may be a listed company. So it has to be evaluated at the time of planning and also at the time of closure. So what does that mean? So when we are talking about evaluation of going concern at the planning stage, it gives us the scope, direction, and as to how to go about the audit. It will help us in deciding the audit approach also. So this going concern standard is not actually restricted to only this 570, but it is they're very much present in 315, 330, as well as the other planning standards, in the in the reporting standards, and in all the other standards also. So we have to evaluate at the stage of planning, and then we will have to evaluate at the closure also. Auditor's responsibility. So what is auditor's responsibility as per this standard? It is to obtain SAAE. SAAE means sufficient appropriate audit evidence regarding and conclude on the appropriateness of management's use of going concern basis. So if we break this sentence into 2 to 3 parts, one is obtain sufficient appropriate audit evidence. So we will have to ensure that we are having adequate audit evidence which we have obtained, and to do what? Regarding and conclude on. So it is with relation to, as well as to conclude on, appropriateness of management's use of going concern. So generally, there is another myth that always exists, is that going concern is my responsibility. I'm supposed to report it if there is any problem. So management has got nothing to do with it. Again, that's not the correct statement. It is the management who has to first, let us know why they are using going concern. The appropriateness of the management's use of going concern is the basis. So they will have to prepare a note, or they will have to prepare a memo to say that this is why I think that the use of management, the use of appropriateness of going concern is proper. And then that has to be evaluated in terms of when we are doing the evaluation of that respective entities going concern, this thing. Now, in making that appropriateness, we will come to that in very much in detail. Management can actually use a very a kind of other evidences also, like cash flow projections, the future projections of sales, how the assets are going to expand, what are the plans of the entity, and all those. We will come to how to test those things as well, because those also become very important. These are the questions that are raised by any of the regulator per se whenever there is a review that happens. When we want to talk, when we have to talk about reviews, there is a any review, when whether it be a QRB, whether it be an FRA review, or whether it be even a local or a other review that the firm will undertake, peer review for also for that matter. So what happens is that these are certain things that are actually all-time favorite, and they will be looked into without fail, because these are the things that actually the reviewers will always pay attention to, and they will always ask about the questions as to how have you evaluated the going concern. So you will generally show a checklist, and some of the reviewers actually go a step beyond and ask you, like, show me the management evaluation of going concern. So that is where there is a hurdle that many people stumble upon, that you may not have a note that has been received directly from the management in terms of the evaluation of the going concern, right? So that is where it becomes very necessary to have that management's assessment of use of going concern, on which you have done your evaluation. Now, testing of those management appropriateness of going concern, we will again discuss on that. Then also, to conclude, based on the audit evidence, whatever we have obtained, whether a MUGC exists, that is, material uncertainty exists. So as per this standard, there can be two situations. One, their materiality, rather, sub situations will come to. One where a material uncertainty exists, second is material uncertainty does not exist. Again, there is always a thought that people have that if the indicators, um, if all the indicators are negative, then only we have to start thinking about it. No, it doesn't mean that. It doesn't say that all have to be there. It just says that these are the indicators. So if any or all are present, then that is where you will start evaluating more and more. Okay, so that is very important again. And when you are looking at all these things, so then you will have to look at it from a holistic perspective and not individually. So one may lead to the other. For example, continuous losses may lead to erosion of net worth. So you will have to look into one indicator, and along with that, whatever indicator actually gets triggered, we will have to look into on that basis. um, and now whether a materiality exists or not exists. So if all the indicators are good and there are no other additional non-financial indicators also, so we were talking about financial indicators, there are non-financial indicators also, like a cancellation of an order, a major litigation, a regulatory issue, something like that. For example, a company is dealing with a chemical, because it is more hazardous, government decides to ban that chemical, or restrict the usage of that chemical for certain products or something like that. So then that actually has a going concern impact on that entity that is actually trading with that specific chemical. So it is possible. So these are the things that are have to be kept in mind. It is not only the financial indicator, it can be a non-financial indicator. Another example, the company is cash rich, but it is sitting on the cash and it doesn't have any business plans, and the directors are actually thinking of withdrawing the money and closing the company. Then also there can be a going concern. Now, this is a completely non-financial indicator, because if you look at the net worth, if you look at the profits, if you look at everything, the company is quite stable, and then it is able to meet all its requirements, and there is no cash flow crisis, nothing. But then there is no interest in continuing the company. Then also it can amount to a going concern kind of a situation. So it has to be balanced between what is the audit that we are, what is the evidences that we are getting, and what is the appropriateness of the management in order to consider it as a going concern. So we have to look at both the financial indicator as well as the non-financial indicator. And when we look at, then we come to something like a material uncertainty exists, material uncertainty does not exist. So if we say it does not exist, then the next step is to look into the mitigating factors. Are there any mitigating factors? Again, there are a number of examples in terms of how mitigating factor, the future cash flow, the projections, the additional things that the management is providing, all those have to be independently evaluated. Now, when we talk about any supporting that the management is providing, again, respective standard has to be applied. We will discuss that more in detail, but respective standard has to be applied. For example, you will have to apply the standard on judgments and estimates to see whether those judgments or the projections that they are taking are realistic. For example, someone is saying that my business will grow by 25%, 30%, 50%. So we need to have that expertise to understand as well as assess, or we have to do the research and we have to get the things right as to if someone is saying that, okay, next year I will grow by 50%, the future year I will go by 100%, 150%. So in the given industry, in the given circumstances, in the given economy, whether they are able to actually justify that 50%, 100% is proper, we have to question that. We have to question those assumptions. We have to question those critical estimates, saying that, see, for example, if they are in a cement industry, and then they are saying that I will, there are constructions going on, so I will raise by 50%, 80%. But then on the other hand, you know that there is a slump in the real estate, and then there are unsold stock that are lying and things like that. So you know those reports are existing. So then you have to question that whether that 40%, 60% is realistic, or because of this slump it will have some effect or intent on that. So these are the type of questions or professional arguments that you have to do, and then document all those. What is more important is that we generally speak about these matters and we discuss with the management, with the CFO, with the CEO and everyone. But as auditors, it is also important to document all these inquiries. So if we look at this standard realistically, we can easily draw a questionnaire on the basis of which we have to actually take an end-to-end inquiry, and we have to take those responses on record, either on email or a signed copy as it is necessary. And then we have to also question any assumptions, projections, everything that is made. Another important thing when we are looking at these evidences and all these additional things that the management provides us, another important thing is that if they are making any cash flow projections, if they are making any assumptions in orders, so those orders cannot be in the air. It has to be realistic. The standard, it tells you that you have to look at those orders, that those orders are there around the corner. They have some evidence to prove that there are some orders. So I cannot just estimate that I will get 100 CR order tomorrow. I have to have some material documentary evidence with respect to that to believe that. Passing a resolution, so sometimes, yes, board resolutions become our evidence, but it is not necessary that they are the sole evidence. You have to do a corroborative evidence check also. So this is actually, that is when we said that it is applying your professional judgment to the best possible extent, and applying your professional skepticism also to the best possible extent. And then looking at those evidences specifically. We will come to holding company and subsidiary relationship and the support letter as well a little bit later. So when you do this, so first is you have to obtain the sufficient appropriate audit evidence regarding, and then you have to conclude on the appropriateness of the use of going concern. Then you have to conclude on the basis of based on the evidences obtained, whether a material uncertainty exists or it doesn't exist. If it exists, then what is to be done is the next question that we come to. And if it doesn't exist, then you can go ahead and issue a clean report. And then based on all these things, then we report in accordance with the said standard. So going concern basis of accounting. What is going concern basis of accounting? The financial statements are prepared on the assumption always that it is a going concern and it will continue its operations for the foreseeable future. Let us take an example over here. What is foreseeable future? So foreseeable future as per the standard is 12 months from the date of the year end. So in our case, for example, if the year end is 31st of March, then 12 months from 31st of March 25 will be 31st of March 26. So whether in the foreseeable future the entity is continuing or otherwise, right? Now, there is another standard 560, which is very important when we are looking at 570, which is in respect to subsequent event. We don't sign the balance sheet on the date of the year closure or 31st of March. We generally do a signing by April, May if it is a listed company, and then if it is a private limited company, we will sign it by 30th of September. Largely, I'm not considering the extension or change in financial year. Largely, that is the larger practice that we all as in this country we have. So when we are doing it, the subsequent events have to be taken into account to also assess going concern, because they play a very important role in terms of, so as on 31st of March, everything was good. All the indicators were good. So, okay, that's the financial indicator. Going ahead, then we have to look at both financial indicator as well as non-financial indicator to assess whether it will be good to go in terms of the 12 months. Another important thing over here is that in the application guidance, I guess, it is very clearly written that from the audit report date, 12 months can be assessed. So it is an option that is given. So say, for example, in our given scenario, if we are signing the audit report on September, 25th of September, 31st of March, the balance sheet was quite healthy. All the indicators, financial indicators, non-financial indicators, everything was good. We had at that point in time decided that there is no material uncertainty. However, we are sitting on 25th of March today. In this five and a half months, there can be significant changes. There can be significant decisions that can be made. There can be significant future course of actions that may get decided by the board or anything. So you have to step into the subsequent event standard again. do all those procedures like reading the minutes, looking at the trial balance, any major litigation that has come up, and all those things that you will have to do. Because you're signing the audit report on 25th of September, you will have to see that as on 25th of September, also taking into account the subsequent event is the entity a going concern. Now, this is a practical scenario, or it is, looking at from the auditor's responsibility. So you can't close your eyes as on 31st of March that this is what existed. I'm fine with it and I'm going ahead. I would disregard any event that has happened after that date. Say in the given example, in the month of June or in the month of July, if there was a major litigation where the company was made a party to, in which there is a large claim on the entity, which may actually completely turn the entity to an upside down kind of a situation. So then we have to actually ensure that that is duly discussed, the legal scenario is taken, the probable possible remote analysis of that is made appropriately, and then a decision is taken in terms of the going concern basis of accounting. Right. So these are some of the scenarios or examples which actually, as we go along the going concern basis, which we can think of. Another question that we may think of is that a company has newly started. So there we have so many startups. So there are two schools of thought that exist in terms of going concern over there. One is this year you have started, you will have a gestation period of say 2 to 3 years. I may have to wait till that period to actually see how do you progress. And that's why I will not put a, sorry, no, I have not changed the slide. Yeah, thank you. Yeah, so we are talking about the startup. So if at all we are talking about the startup, and then if there are two schools of thought that exist. One is like, you are having a basic gestation period of 2 to 3 years. And then if you have 2 to 3 years, then maybe within that period, I would look at your business plan, I would look at your projections, I would take your representations, and maybe I'll not put a material uncertainty in going concern. However, strict interpretation of the standard, if there are indicators, even though you are a startup and you are in the gestation period, you can give a proper note to that effect, and then you can do a material uncertainty para with a mitigation factor. I think that is another important situation that can be considered, and there are two schools of thought that exist here. So the more conservative view being, you are putting up a MUGC para in the file. General purpose financial statements, which we know, which is actually where in the report is as per SA 700. These are generally prepared on the basis of accounting, going concern basis of accounting, unless the management either intends to liquidate the entity or to close or cease the operation, or has no realistic alternative but to do so. So this is by force or by willingness they are going to close down, then it will be on no going concern basis. So that is on liquidation basis, where all assets and liabilities are stated at the realizable value. Now, special purpose financial statements, or which are may not be prepared in accordance with the financial reporting framework, for which going concern is also relevant. Again, if you are preparing only for the set of purposes of bank, if you are preparing for the purpose of consolidation, or in a foreign entity, something like that, special purposes report, which is actually guided by SA 800, where you report in 8 SA 800 or 805. There also going concern plays an important role, and you will have to consider going concern accounting. So when the use of going concern is appropriate, assets and liabilities are recorded on the basis that the entity will be normal, and if it is completely on no going concern basis or liquidation basis, then it will be on a realizable basis. Now, responsibility for assessment of entities' ability to continue as a going concern. This is again very important. The primary responsibility lies with the management. So it is always the management's responsibility to assess the entity's ability to continue as a going concern. even if the financial reporting framework does not include an explicit requirement to do so. What does this mean? Financial reporting framework may be IFRS, maybe Ind AS, accounting standard, whatever, or German law, British law, whatever, accounting standards. Irrespective of the fact that whether there is an explicit statement in the financial reporting framework to assess the going concern or otherwise, to start with the accounting, it is the primary responsibility of the management to actually assess the going concern. So it starts all with the management, and that is why management's assessment of going concern, the memo on management assessment of going concern is mandatory in the audit file. There are no two ways to it, that I may take it, I will take it. It is not applicable. It is not, it is mandatory only in case where there is a going concern issue. Nothing doing. The management assessment of going concern memo has to be there in every audit file. Even if it is positive, it is advisable to take the management assessment of going concern, do the inquiries, and then you have to document. So this is a very important piece of document, especially as we are signing the financial statements after the year end, after a couple of months or 6 months after the year end. So it is very much important. It's a very important piece of document to collect this and then keep it in our and retain it in our audit file. Management's assessment of the entity's ability to continue as a going concern involves, what does it involve? It involves a judgment at a particular point in time. So management can assess on 31st of March that I am a going concern. So it is at a particular point of time about inherently uncertain future outcomes of events or conditions. So what does that mean? That is like, as on any point of time, one of the examples we took is that we are signing the report on 25th of September. So for the purposes of signing on 25th of September, we need a management assessment of going concern as on 31st of March, including events up to 25th of September. So that is important. So it is at a particular point of time. So it may have changed over a period of time, and it is very necessary to capture that change, because without that change, maybe the assessment will also change. So in our example, we said there may be a larger litigation that has come up during this period. So if that is missed out, then the management assessment of going concern may not be suitable anymore. What are the factors that are relevant to the judgment? The degree of uncertainty associated with the outcome of an event or condition. Sometimes it is very straightforward. There is nothing that is happening. Everything is cool going on. So there is nothing much to do. So you conclude that everything is fine. And then the management also concludes that the management concludes everything is fine. And then the auditor also looks at it and then closes on it. However, there can be certain events where there is a degree of uncertainty associated with the outcome of an event or a condition. So litigation that we gave as an example, or a law that is going to be applicable from so and so date. So you don't know, there is an uncertainty as to what will happen if the law gets implemented, what is my position in the market, what are the things that will affect. So the entire industry may be in a question mark as to how to deal with it. Or in case of a litigation or something, the outcome of an event may be uncertain. I don't know if it is, say for example, a company which is actually into manufacturing and it is supposed to follow certain pollution control laws. These days, the environmental laws are getting more and more stricter and stringent for the good of the world. So if there are any violations of some pollution of the pollution control law, so this as such may be a financial indicator also, a non-financial indicator also, because the violation will first trigger the penalties, and if it goes to severe extent, then maybe it can be asked for a it can ask for a shutdown of the entire premise or affecting the entire entity. So there have been a couple of cases, as you may have heard, which was there in the newspapers a couple of months ago, a month or so ago, wherein in one of the districts of Maharashtra, there were 2-3 factories that were shut down because the water was heavily polluted and they were not adhering to the pollution control norms. So they had to shut down the factories. So it can go to that extent. So what is the degree of uncertainty that is associated? Now, if the management exercise of the subjectivity is higher, then it is difficult for the auditor also to test the same. So when there is a larger degree of uncertainty associated with the outcome of an event or condition, then from the auditor's perspective, it may not be possible for us also to actually evaluate it or read the note and say, this is fine, we can go with it. Maybe we will also need an independent opinion. For example, if there is a litigation that is going on, if it is a heavy tax demand that is there, maybe we will have to consult an expert in the given case. Or if in the example that I mentioned, if there is a pollution control issue that is there, maybe we will have to loop in an external consultant or someone, or expert in that field, to assess the implication and conclude on the going concern. Because there may be a situation where that the company may be saying that, okay, we will be able to pay the penalty, settle the case, it will not go further. But then there is a situation where there can be an uncertainty that is involved, and if we sign the report and within 5-6 months, if the entity is going to shut down or something major happens, then there will always be a question on the auditor's judgment as well. So when there is a degree of uncertainty, higher degree of uncertainty is associated with the outcome of an event or condition, and if management is exercising that level of, or that degree of uncertainty, then it is necessary for us as auditors also to be cautious here, and then the necessary external evidence gathering or corroborating evidence gathering, or appointing an expert and then coming to a conclusion. Another factor may be size and complexity of the entity. There can be straightforward entities which are into trading, or which are into, a kind of one type of activity, but then there can be many entities which have which are quite large, like a retail setup which has 45 stores across the country. The complexity that is involved in the business, the same company is into multiple segments, it's into F&O, it's into crypto trading, it is also into media, it is also into some other. So the size and complexity, so there is also a problem that when we look at these kind of entities, then we will have to maybe bifurcate or bucket it into different types of percentage, or the revenue on the basis of segment or the units, as the case may be. And if there is a major unit in the given example, say the entity is more into the crypto business or something, and then there is a uh, regulation by RBI or any other entity which actually bans the trading in crypto or something like that, then it may have a larger impact. So the company may try to actually justify or just saying that we have other lines of business also, but then we will have to see about the materiality or the impact of that specific segment on the overall continuity of the going concern. This also gets into, particularly important when we come to the holding company and subsidiary company kind of a evaluation, and the group level evaluation also. The next thing is information that is available at the time the judgment is made. Sometimes the information may be, a day later or a day sooner, but then, what is the information that the company have had at that point in time is very critical and very crucial for the purpose of making this judgment. If there is anything that happens after that, obviously audit is always not static, and then it changes as the situation changes. But then here, for the making of the assessment of going concern, it is very important to look at the information that it has at that specific stage. We spoke about planning stage, wherein SA 315 as well as SA 330 talks about going concern as one of the risks. So when we look at SA 315, for example, when we look at the risks, one of the examples that it gives as, in the risk, when we identify the risk for the business, one of the risk may be going concern risk, for example. And when we come to going concern risk, it is always regarded as entity level risk and not assertion level risk. So when we look at the risk on the basis of likelihood and magnitude, and then we classify it onto assertion level risk and entity level risk. For example, assertion level risk is related to something like an inventory valuation, a one of its case or things like that. Going concern risk, if it is there, then it is a pervasive risk and hence it is looked at as entity level risk. And in case of entity level risk, it may affect one line item or it can affect more than one line item. And when we are saying it can affect more than one line item, if we perceive the risk of going concern at the time of planning, then our audit procedures will have to be accordingly steered into, or our audit approach has to change completely. That means if we say that the beginning or the planning stage materiality, going concern as a assessment, if we say there are indicators of going concern, at that stage we should start discussing with the management. And then if the management also says that yes, we are going to shut down the business, or we have certain conditions that are not good, then we will have to incorporate that into our audit approach. Say, for example, the line items may then be required to be stated at realizable value. So our testing with respect to how it should have been at the historical value versus how it should be with respect to realizable value. The perspective actually completely changes, and it has to be in that level that we will have to bring it in, and then we will have to change our audit approach. Another thing that SA 315 specifically says is, when we planned, there were no indicators, there were nothing that was non-financial also that exists. Later on, at some stage, if you have some non-financial indicator also towards going concern, again taking the same example of change in some law, then if you see that there is a challenge in respect of going concern, something may happen to this entity, then you will have to reincorporate that, redo your risk, and then come to a reconclusion on how you are going to do that, and you have to reevaluate and change your entire approach for audit. This is something that is necessary. These things may sound more theoretical, but practically, in a way, we all are doing it. But the only thing is, how do you demonstrate it in terms of at the time of any audit or any review or anything? So documentation is the only thing that you can actually substantiate, and you can, demonstrate that these things have been done. In short, if the management has performed the assessment, auditor has to discuss this with the management, determine whether they have identified everything appropriately, all the conditions, everything. Is there any doubt, and what is the management's plans to address them? If the management has not performed the assessment, then the auditor has to discuss with the management how and what it is going to do, and then it has to conclude accordingly. So in either ways, it is necessary for the auditor to actually look at the going concern at the planning stage. And as we discussed, while doing the audit or while executing the audit, the auditor has to remain alert throughout the audit for audit evidence of events or conditions which may cast significant doubt on the entity's ability as a going concern. So these are some things that are very much necessary. At the execution stage, so actually the standard is not split like this at the planning stage, execution stage, as well as the closing stage. I have done it for the purpose of ease of flow or adjustment of the flow. Execution stage, at this stage, it should evaluate, we have to evaluate the management's assessment continuously. In evaluating this assessment, we have to look at the applicable financial reporting framework, or by law or regulation if it specifies a longer period. So as I mentioned, the standard actually talks about 12 months from the date of the year end. However, in the application guidance, 12 months from the audit period is also something that is mentioned. So we will have to take care of that. A couple of financial reporting frameworks in some other countries actually says 15 months. So that is very unique for those countries. So any law that you are using or regulation that you are using, you will have to take care of those requirements, and you will have to ensure that those things are in line. If management's ability to of the entity's ability to continue as a going concern covers less than 12 months from the date of FS, auditor will have to request the management to extend its period for 12 months. So 12 months from the date of the financial statements. So say in our example, it is 31st of March is the year end. So 12 months from that date is mandatory. If it is anything less than 12 months, it is mandatory for the auditor to go and ask for additional evidence and ask for assessment note to be completed for 12 months. There can be scenarios wherein, they are doing some December reporting for the purpose of their parent or the group audit. So they say the note is ready. You can take the same note. And they say there are no changes in the scenario. And then, we as auditors, we also look at those things and then we say, yeah, largely there is no change, let me take it. But then these tiny things in terms of the documentation matters a lot because it was December year end. It is not 12 months from the end of the financial period for the purpose of statutory audit, which may be 31st of March. So you'll have to get that note updated. You'll have to ask the management to update that note and give it to you so that you also look at it from the 12 months period, and then if there is any subsequent event, you will have to take that into account as well. Next, in evaluating management's assessment, auditor has to consider whether management's assessment includes all relevant information of which auditor is aware of the result of the audit. So that is when we said that if there are any non-financial indicators, there are any other factors that are actually have to be considered, which would have to be considered, but which are not considered. So please speak to them and get it included. If period beyond management's assessment, then inquire of management as to its knowledge or event or conditions beyond the period of management assessment that may cast significant doubt on the entity's ability to continue as a going concern. So include all the events that are subsequent as well as it is very necessary. Sorry. Audit procedures that are necessary. So this is most important at the planning stage. If there is management assessment and there is no issue with respect to going concern, then identify the risks and then go on with the audit. If there is uncertainty, either as identified by the management or as identified by the auditor and discussed with the management, identify it as a risk, and then it will become an engagement level risk, and then the audit procedures will have to be changed accordingly. Now, at the end of the audit, till the audit was on, everything was good. And then at the end of the audit, there are some indicators that are actually going haywire, or there are some non-financial indicators. The company has taken some decision to sell off some unit or something like that. Then that casts a significant doubt on the material uncertainty. Then again, there are a couple of things. One is there is no uncertainty as such. Again, coming to the end of it, then do the audit procedures, take the assessment, do all testing, and then close it. If because of those, if there are any material uncertainty factors, then we will have to ask the management to give additional evidence. And we talk about additional evidence. It may be future cash flows, projections, order book, opening of new chain of business, expansion plans, financing, new credit lines, merger, demerger, whatever it is. All these things, what we are saying, cannot be spoken to or cannot be in the air. These all need certain evidence. For example, if we take an example of order book, there has to be physical order book and there has to be orders that are present to say that the business will be continuing. Okay, say for example, if there is a customer order, a major customer who is lost. So if the things are under negotiation and if it is going to continue, there has to be an indication towards it. If there are no indications towards it, then that has to be brought in very clearly. Cash flow projections. It cannot be haywire and it cannot be on the basis of assumption that is not realistic. These cash flow projections have to be appropriately discounted, tested for real, real sense. There have been a couple of orders or judgments, if you see, wherein the auditor is held responsible for not reporting a going concern matter because he had relied on some cash flow projections and he had not tested it appropriately. Okay, so testing of these cash flow projections is also very important because these days, on Google or anything, if you do a cash flow model, you can easily get hold of a cash flow model and you can actually prepare it. Even on AI, you can prepare a cash flow model, so it is more easy to do that. But then the underlying assumptions, so even in the AI cash model, if you want to generate, it asks for certain assumptions and it asks for certain industries and things like that. If you have a macro that is written, so those assumptions, those questions that you ask have to be very particular and very pointed, and you have to have the industry knowledge. So that is when I give that example of construction industry. If you're saying that, okay, my stocks will reach the sky, I will sell 100% more units next year. But then if you know that the market information says that there is a slump in the construction industry because there are lots of unsold stock, you will have to ask for corroborative evidence that how is it that you are saying that you will flourish, whereas the whole market is not going well, right? So these are the type of questions that we will have to pose it to the client, and then we will have to test the data actually. If the client is using some complex models, then we will need a expert analysis also, or an expert input also. Now, where management has not yet performed an assessment, you have to request the management to perform an assessment in the given case. Management's evaluation of future plans, we spoke about. Cash flow forecast, we very much spoke about. Any other additional facts or information that have become available. So, for example, the company may tell you, okay, I'm going to open 10 stores in the next 6 months. So it cannot be just a resolution or just a plan saying that I'm going to open 10 stores. Okay, realistically, show me what are the plans that you are doing and how are you executing them. So the visibility of those 10 stores have to be there. It cannot be just in the air. And with respect to all these, then you will have to take management representation also. So that is again necessary. In case of group audit, or in case if you are doing a audit of a subsidiary of a large entity, so there may be going concern issues in the smaller entity. That means your subsidiary, the entity that which you are auditing. So case one, we are auditing a subsidiary. So a subsidiary has a going concern issue and parent is large, it doesn't have going concern issue. So the parent tells the subsidiary that I will support you for all your operations for the next 12 months or for the next 1 year or whatever. Here, when you're taking the support letter, which is this letter is called the support letter from the parent, there is an illustrative also in the going concern standard. SA 570, there is an illustrative support letter also, and there are some wordings also. Not the exact illustrative support letter, but it has some wordings. This support letter has to be unconditional. That is very important. It has to be addressed either to the board of the subsidiary, or directly it can be addressed to the auditor also, only when auditor has asked for, because it is the primary responsibility that management has to look into. It is better that if it is addressed the board of the subsidiary. And when we take that kind of a support letter, two things we will have to do. One is see whether it is signed by the authorized person of the holding company, which it will be most of the cases. Second most important thing, we will have to look at the going concern of the entity that is giving this letter. So whether that entity is supporting also, we will have to check. For example, the one who is actually giving the going concern support himself, if he is in a going concern issue, if there is anything in the report of that entity, then you actually are looking at a part of the entity that is already heading towards no going concern. And that cannot be a valid support letter. That has to be very critically evaluated. There is also a case wherein, in case of standalone private company or a public company, the promoter gives support letter. So there, the promoter's standing will have to be seen as to whether he will be able to support or not. It cannot be a case where the promoter himself is heading towards bankruptcy, but then he is giving a support letter to someone. So basically, I have to stand on my own feet. If I cannot, then I will need a crutch or a stick. Now that stick has to be stable. If the stick is not stable, then definitely I'm going to fall. So that's the logic, and we will have to evaluate these things. Second scenario we will take. So this was standalone entity. Second scenario, subsidiary of a parent. Third scenario, let us take where we are auditing the group of companies, that is the holding company itself. When we are evaluating and the subsidiary also. So say for example, in two subsidiaries, there's going concern issue, and then the parent has given support letter to those subsidiaries. Now, when we are looking at the parent entity audit, we will have to evaluate the going concern at the group level. We cannot, like line by line consolidation, we cannot add 1 plus 1 plus 1 and then take a overall basis, but then we will have to look at from the group perspective. That So we have to look at whether that is viable or not from the group perspective. And then when we are looking at the going concern of the group perspective, then we will have to take into consideration of the fact that it has already given support letter to two of these subsidiaries. So that value has to be taken appropriately over there. So these are some of the things that we will have to keep in mind when we are looking at individual as well as group entities going concern factors. And then on the basis of all these things, we will need a written representation. But one of the things that we have to very much remember that only written representation is never a sufficient appropriate audit evidence. It always needs a proper justification, working, backup, and paper. So if you see some of the orders or if you look at some of the cases, it is the lack of documentation is one of the major reasons that the going concern stand that is taken by the auditor is not justifiable. So the auditor must have taken that stand on the basis of available information or on the basis of his workings. But most of its case, this is so much of judgment that it gets missed out to be documented, and that becomes very, very necessary. Completion stage, yes, most important. We talked about most of the things that has to be covered in the completion stage during our discussion in the last 1 hour. Use of going concern basis, if it is inappropriate and auditor do not agree with the basis of accounting, then you have to express a qualified opinion or disagreement. Maybe it will cause an adverse opinion or disclaimer of opinion also. So let me take a couple of minutes over here on this. Largely, if going concern is getting affected, qualification on going concern is a very difficult stand because you're saying balance sheet or the financial statements have to be on liquidity basis. So taking a situation where client is saying, I'm good to go, okay, and we are saying, no, it is not because there are indicators. So client is saying there are indicators, and then I have these as supportings or projections or whatever. But then we are saying that you have these indicators, your supportings, projections, things like that are not tenable. So actually you're not a going concern. That means you should have prepared your financial statements on the basis of liquidation. If that is the case, then actually clearly it is a case of adverse opinion. You do not have enough information to test the assumptions, then it goes mostly towards disclaimer of opinion, but very less cases. So if you have agreement, disagreement on going concern, it can either be a clean report or it can be a complete adverse opinion. Qualification, when will a qualification arise? So there are certain cases where qualifications may arise, where you are not agreeing to certain stands that the company is taking. However, you don't say that everything is wrong over there, but still going concern assumption is not much acceptable. Then there is a third situation wherein company has a problem, MUGC, it has given supporting, and then that is what we used to do in the past in terms of EOM, emphasis of matter, which is no more emphasis of matter, and there is a specific MUGC matter. So when we say it is a MUGC matter, that means you have there is a material uncertainty existing, but you have certain supporting to it, for example, a support letter or something, and then you write that our opinion is not modified to this effect. That means there is a material uncertainty exists, but then it is not affecting the overall ongoing of the company. So that is the third case. And fourth is where you are directly disregarding what the company has to do, and it is actually a complete disclaimer or a adverse opinion. Yeah. So unmodified opinion with respect and MUGC para is something that is common, and then qualified or adverse opinion is the extreme situation. So it is very difficult to treat between a going concern and a no going concern, a path over here. Either it will become completely reverse or otherwise. So this is very important, and then there are illustrations in this um standard, in the application guidance and in the standard, wherein it covers all these situations. There is a lot of literature in SA 570 which talks about the group evaluation also, which talks about the support letters also, which talks about the intricacies of how going concern has to be seen on overall basis. So there is no going concern issue, and then auditor also agrees. Then there is unmodified opinion, no need of MUGC para at all. And and then if all evidence has not been evaluated and possible effect is so pervasive or material, this we discussed that it will go into mostly the adverse opinion or a qualified opinion or a disclaimer of opinion. When information is not available, that is when you give a disclaimer of opinion. When information is available, but then everything is wrong, is when you give adverse of opinion, and then if you agree with, then you give a clean opinion. So going concern is very difficult to be a qualified opinion in my view. It can be, but it is a very difficult situation to be a qualified opinion. It is either a disclaim, it is either adverse or a positive one, that is no going concern, that is a normal going concern one. CAM, whether going concern matter can be a CAM. This is one question that is very important to be answered. CAM is guided by a standard in itself, SA 701, as we know. And this is a very specific standard which actually gives the characteristics of what a CAM can be and what are the things that we can report under CAM. If there is a material uncertainty under going concern, material uncertainty relating to going concern, which is a MUGC para, largely this is not a CAM matter, because CAM is something that actually can be a significant risk. It comes from the reporting to TCWG, and it is not something that needs a specific reporting anywhere in the audit report. We have a specific placement for everything, and CAM is a very specific thing in terms of what are the additional procedures done with this effect and what are the things that we have done in this direction, and then we report a key audit matter in the audit report. It has got so largely these two things are completely a little bit different, and this can never be MUGC can never be put into a CAM para, or CAM can never be a substitute of MUGC if we have to put it up in an appropriate manner. There are items wherein either because people want to avoid putting it into a EOM or a qualification, people try to fit it into CAM, but then that's not the right approach, because we have a placement specifically for MUGC, and the CAM won't fit into MUGC. So certain combining subsequent event standard or SA 560 into SA 570, very important again. As we mentioned that we don't sign the financial statements on the date of the year end. We sign it always later. It may be 20 days later, it may be 6 months later, but we always sign it later. So subsequent event standard plays a very important and key role in terms of how we look at the going concern. There can be many factors that are sitting in the subsequent event that can affect the going concern scenario. And all the procedures that are actually mentioned in subsequent events are very important to be considered in case of going concern. So first and foremost, we have been talking throughout from the last 1 year that there is a necessity to maintain professional skepticism. Professional judgment plays a very important role over here. Consider whether sufficient appropriate audit evidence is available to be able to assess what is the impact on the business operation, revenue, cash flow, etc. of the entity for the year, appropriateness of the use of going concern, basis of accounting, existence of material uncertainty related to going concern. What are the disclosures that are made in the financial statements? Now, largely, whenever we have an MUGC, we will have a corresponding note in the financial statements. So that note has to elaborate on why there is a going concern issue also, and why the company believes that it is okay to actually continue with the going concern assumption. And that is what you will bring it into MUGC para if you agree as an auditor that a material uncertainty exists, but it is mitigated. And that is why you are not modifying your opinion. If that is not the case, then you go to adverse opinion or the disclaimer or the qualification. So we all know that in case of disclaimer or adverse opinion or qualification, we don't need to actually have a reference of the note. We can independently do a qualification or adverse opinion or a disclaimer of opinion. That's very important. And when you have a MUGC, 99% it is supported by a note in the financial statements. Assessment of subsequent events, we have been talking about this over and again. Decisions that are taken to continue business or the closure of business, very important to see. So board resolutions, trial balances, all the major entity, all the major entries, the important discussions in relation to the business, and also any important decisions that are taken in relation to the business, closure of any of the units, merger, demerger, decisions, all these become very important in terms of the going concern. And also any major litigation, so confirmations from the lawyers or the relevant people is also very important. Major decisions of retrenchment, voluntary retirement that the company is offering, that also is a very important trigger to see whether they are going to continue or otherwise. And also assess all the adjusting, non-adjusting events in view of going concern. So we know adjusting, non-adjusting events, what can be adjusting events and what can be non-adjusting events in terms of accounting parlance. But if there is a non-financial indicator which can become an adjusting event in terms of going concern, not in terms of accounting balance, because then it will topple down the balance sheet from the going concern assumption to actually realizable value balance sheet. So we have to be pretty careful and attentive towards it. Considering above factor, we have to evaluate a possible impact of the audit report. One, on the modified audit opinion, that is as per 705. If there is inadequate disclosure, or if there is improper accounting, or if there is we are unable to obtain sufficient appropriate audit evidence, if there is anything that actually comes to specifics, then it can be emphasis of matter. But MUGC has a specific para, so there is no emphasis of matter per se. It sits into the MUGC para. Key audit matters. Key audit matter, it cannot be a substitute to MUGC para. I have just to make it more interactive, I have just put up some case studies for you to think about. I'm putting up the case study. You can look at it, and then you can actually type your answers in the chat maybe. So Vivek, if you are able to help in reading out the chats or the answers, that would be great if you can support, please.
Yeah, okay, ma'am. Sure, ma'am.
So case study 1, you are the audit manager responsible for performing some of the reviews on the audit files where there is a potential disagreement between firm and the client regarding a material issue. You are reviewing the going concern section of the audit file of Sunshine Limited, ABC Limited, whatever you call, a client with considerable cash flow difficulties and other less significant operational indicators of going concern problems. Working papers indicate that the company is currently trying to raise finance to fund operating cash flows, and state that if the finance is not received, there is significant doubt over the going concern of the company. Working papers also concluded going concern basis of accounting is appropriate, but it is recommended financial statement should contain a note explaining cash flow problems, along with a description being sought and an evaluation of going concern status of the company. The directors do not wish to include the note in the financial statements. What would be your answer? Whether a note in the financial statement has to be included, whether this is a material uncertainty question, what is it? What is it that you would like to do as an auditor? If you can have some answers, please. Are there any answers in the chat?
No, ma'am.
Okay. Okay. I go ahead with the answer. The audit report in this case should contain a qualified or an adverse opinion due to the disagreement because the auditor is not agreeing, and also there can be a disclosure in the, because we are going with the adverse or the qualified opinion, it's not necessary that we have to have a note in the financial statements. However, we have to make, as auditors, we have to make a final decision as to the significance of the non-disclosure, and that also can be included in the given case. A second scenario, if in case study 1, if the directors agree to give the disclosure note, then what would be your answer? Make it simple. If there is a disclosure that is explicitly provided, but still if there is a disagreement, and if the disclosure is adequate, then and the disagreement is resolved, then it may go to a material uncertainty para with us express saying that there is we are not modifying our opinion. However, if the disagreement continues, even though they disclose in the financial statements, it will be then a going concern issue, and then you will have to give a adverse or a qualified opinion. So the opinion will not undergo a change over here. XYZ Inc. is a manufacturer of televisions. Domestic market for electronic goods is currently not doing well. Therefore, many entities in this business are switching to exports. As per audited financial statements for the year ended 31st March, entity had net loss of say 120 million, current assets aggregate to 1200 million, and current liabilities aggregate to 1500 million. Due to expected favorable change in the government policies of the electronic industry, entity is projecting profits in the coming years. Further, shareholders of the entity have arranged for additional source of finance for expansion and plan to support its working capital needs in the next 12 months. So, is it okay if the entity prepare the financial statements on a going concern basis or no? This is pretty simple answer. If we can yes or no, if we can have yes or no. Is it okay to prepare the financial statements on going concern basis?
Yes, ma'am.
Yeah. Any answers?
Yes, ma'am. We are receiving yes.
Okay. Great. Yeah. So if one of the things is that answer can be yes if the assessments that are done and the government policies that they are stating are all true and you have corroborative evidence with that respect. then you will give a MUGC para, and then you will say that this is not actually modifying my opinion. But if you do not have corroborative evidence, and if it is only hearsay and it is not a thing that is out in the public, then you may want to still go on a conservative basis. A company is an exclusive seller in the country for retail sale of imported branded garments, and it was set up 2 years ago, having share capital of 1 lakh and unsecured loan of 200 lakhs, and has accumulated loss of 50 lakhs. Okay, unsecured loan has been granted by promoter along with his family. Now, company is having negative net worth and negative working capital. Promoters have sufficient net worth and have plans to invest in the business in future. Whether it is, we'll come to the gathering of audit evidence, but then whether it is okay to continue preparing any of the, the financial statements on the basis of going concern, yes or no. This largely seems like a, smaller startup or a regular day-to-day business for many of us, where, these kind of things are pretty common, where promoter wants to invest in the company and they want to take it forward. So whether this should be a going concern, so accounts should be on going concern basis or on liquidation basis. Going concern basis, yes or no, you can mention yes or no again. Accounts are on yes, going concern basis, not on yes basis, sorry. Largely yes, and then whatever we want to have, we can have the cash flow projections, detailed business plans, support for the entity's ability to obtain new funding. Also, the support letter you have to take, and then you will have to verify the promoters, assessment also as to how good they are in terms of their business plans or in terms of their ability to support. One more. ABC company files a suit against unlucky company for 5 crores. Attorney of unlucky company feels that the suit is without merit. Unlucky company merely discloses the existence of the lawsuit in the notes accompanying its financial statements. As an auditor of unlucky company, how will you deal with this situation? Whether you will qualify, you will give a disclaimer, adverse, or you're okay with it. Okay. We have to evaluate in detail what are the source data on the basis of which the opinion is formed. Evaluate the appropriateness of going concern assumption. This is very limited information. If auditor has found the uncertainty, then there has to be like probable possible remote analysis. Then there can be a provision of 5 crore. If management does not accept the request in this case, or if it is because there is nothing much that is done by the lawyer, then make the provision, or otherwise you go ahead. If not made, then you can qualify the audit report, but if it is proven that it is remote possibility, then it is you can give a MUGC para, or then there can be nothing also if there is a remote possibility. So these are some of the suggest wordings which are actually picked up from the public domain. Nothing very specific as to how you go about the use of the going concern basis for uncertainty for financial statements. Couple of them I have just put on for references. I think these are all largely from the liquidation from the specific public domain reports. So as a part of conclusion, now another important thing I would like to state, when we decide that it is not of going concern, then you prepare the financial statements on the basis of liquidation. Now, there is no format of audit report that is provided in any standard in terms of how do you report on a liquidation basis audit report. So it is just customs and practice that people put an, the basis of accounting will consist of a note, the background will consist of a note that it is not on going concern basis. It will be referred to in the audit report, in the management responsibility para as well. And then there can be a UM to that respect, saying that this is on the financials are on liquidated basis. Because the financials are already on realizable basis, there is no qualification specifically because adequate disclosures are given. So this is the general practice that I have seen. There is no standard guiding this specifically, wherein everything that is done on going concern basis, the standards are towards those things. So the role of auditors at times like this currently are under more and more scrutiny because there is a lot of public interest obligation to complete the audit in accordance with professional standards and requirements. Auditors, as such, we need to exercise high degree of skepticism and then be prepared to call out where the company's narrative that the board presents is not specifically enough and does not tell the whole story of various scenarios and also the uncertainty specific to the company's operations. So we should not be thinking twice before doing this because that is our duty. So the terminology from whether you are a bloodhound to watchdog to a bloodhound is something that is blurring. The difference between audit and forensic audit is also blurring. So in view of all this, it is necessary that actually we look at all these things more carefully and then we look at these take up these reporting responsibilities more carefully. Most importantly, documentation is very, very important. These are areas which we know by the back of our hand as auditors, and we are doing this. And we are actually doing all the inquiry procedures. We're discussing this with the relevant people in the management. So the only thing that is largely lacking is documentation as to whom we spoke to, when we spoke to, what are the assumptions, how did we test the assumptions, how did we test the cash flows, how did we ask about the assumptions, because professional judgment is something that we gain by experience and that is already sitting with us, but then it is not demonstrated. The questions are asked, but then they are not documented. At times, not appropriate questions are asked, and then there is reliance on the management, which is not appropriate. So these are the things that we have to take care because going concern assumption, how you have tested, what you have done, what is the work that you have done at the time of planning, at the time of completion, at the time of execution is something very typical, and this is more of subjective nature and also involves a lot of professional skepticism and professional judgment. So it is imperative that all these questionnaires are properly documented, the relevant paras included in the management representation. Now, management representation is not the only evidence, but it is part of the evidence. So only taking management representation again is not a solution to doing the audit work. We have to do our work at the same time, we have to take the management representation as well. Irrespective of whatever the challenges and uncertainties, there should not be any dilution or non-compliance with the auditing standards in carrying out the audits because auditing standards are more important, and more so auditing standards as of now do not have different levels of applicability like accounting standards wherein you have 1, 2, 3, 4 level, you have Ind AS, you have AS and things like that. So here there is no difference in terms of what is the auditing standard applicable to a smaller entity vis-a-vis the larger entity. Going concern assessment for a primely is very necessary for all size of entities, and it is ever changing because there are a lot of changes that are happening in our ecosystem, in our laws, regulations, how the country is progressing also. Say for example the tariff, non-tariff, de-tariff kind of a situation, new laws and regulations, some war situations in some other countries which are actually affecting the um, demand and supply in the country. So all these things pose various risks, and amidst all these things, it is very necessary and imperative to look at going concern as a very critical, assumption. We cannot assume that it will always be going concern. Rather, we have to always test the going concern assumption end to end and in detail so that we get the appropriate comfort in terms of how we go about it. I think largely that's all I have. If we have any questions, we can take that up.
Yes, ma'am. Yes, ma'am. We have received lots of questions during the session. Ma'am, before that, I would like to apprise you that today's session we have joined by more than 1200 members, ma'am.
Great,
So,
great. Thank you so much.
so I just read the question and put the question in chat box also.
Sure.
So I will take question one by one.
Yeah, sure.
So the first question is: a company has been operating as a going concern for several years. Currently, the director, having attained senior citizen status, have decided to continue the company's operation. However, its income is now limited to rental income from leasing out its building. The company does not intend to state that it is no longer as a going concern, as it may undertake business activity at any time in the future. In this context, what are the disclosure requirements applicable to the company?
So right now, first of all, you have to look at the financial indicator. So from the facts that you have given, I can understand that the company was doing well, but right now they are just waiting for new business opportunity or some continuity of business. That's what I can understand from the question. So as I mentioned in one of the examples, going concern is not only about the indicators, financial indicators, it's also about the non-financial indicators. So today the person has attained the senior citizen status. The person does not have any business plans. That also puts a question mark on the going concern assumption. So if there are no major receivables, payables, or even if there are, this is a fit case for preparing the financials on a realizable basis, because I'm assuming that because there are no much business activities currently, there must be more of routine payments and receivables. So I think it's already largely on the type of realizable value. If it has huge PPE or anything, then that has to be then bought at the realizable value. At present, if they show a definitive business plan, or if they have anything concrete to say that I'm going to start a business within 3 months, 6 months, and they show your business plan, and then there are documentary corroborative evidence to that effect, then it can be a normal audit report, maybe with a MUGC para and with the supporting line.
Ma'am, the next question is: what can be the critical factor or key consideration for assessing the going concern assumption when a company or industry has been experiencing a recession for a few years due to global issues, but to expect to return to normal in the future?
Sorry, not very clear with the question, but what I understand is that there are some key changes due to some global policies. Is that right?
Yes, ma'am. Yes,
Yeah.
right, ma'am.
Yeah. So if there are some key changes due to global policies, I don't know what kind of global policies you're talking about. If it is something related to, indicators that are known to you, then maybe you will have to evaluate those parameters. If it is a very specialized subject, something like a sustainability or something like, a specific technology, for example. So if there is a technology driven company and there are global changes in the policy or things like that, then those are the things that you will have to take into consideration in terms of how do you want to assess this. And if you need, then you will have to maybe appoint an expert to take a view, or ask the company to do an impact analysis. At times what happens is there are some change in laws and regulation. Maybe the company is also not privy to all the aspects of it. If there is global change that you're talking about, then maybe ask the company to do an impact analysis, and then you look at the impact analysis, or you get an expert to do an impact analysis. I think those are the solutions that we can give, because the underlying subject matter is not there in the query.
Okay. Ma'am, the next question is how should the going concern assumption be evaluated in the case of a company that has been declared by insolvent?
Yeah, if it is already declared as insolvent, then the financial statements have to be on realizable basis. I guess it if it has filed for bankruptcy or if it is declared as an insolvent, then there is no two ways about it. It has to be prepared on realizable basis. Right from the background, the notes to accounts, everything has to be, nothing has to be on historical basis. All the receivables, payables, asset, liability, everything has to be stated at realizable value basis. And accordingly, the audit report will have to be prepared, saying that the financials are not on going concern basis.
Ma'am, in next question, in the case of IBC proceeding, it is probable that the company will be revived. So before the NCLT order approving the plan, how will be discussed whether it is going concern or otherwise?
Yeah, this is a very classic case. Once the company goes into the IRP proceedings, it's seen as a MUGC qualification or an adverse opinion status. It can obviously not be a clean report in terms of material uncertainty because the plan may get approved, the company may get sold off completely, assets may be realized and distributed. So this is either no going concern or a realizable value basis company, or it can be a qualified or an adverse opinion for sure. It cannot be a clean report because I think everywhere when the company goes into IRP, that is the stage that you have heavy uncertainty on what is going to happen. What if the plan doesn't go through? What if the NCLT says that in public interest, sell off all the assets and liabilities and pay off your dues? Right? It is possible, right?
Okay. Then the next question is if some organization is facing cash crunch, then whether organization is having a going concern issues. If material uncertainty exists, then what accounting policy changes have to be implemented? And also clarify how to report the going concern issues in audit report and CARO 2020.
Uh, So, if there is cash crunch, so what is cash crunch? Whether it is cash losses, operating losses, to what extent the cash crunch is there, and are there all negative indicators in terms of losses, negative net worth getting eroded? All those factors will also have to be seen. What kind of cash crunch? I'm not very clear, but then assuming that it is a routine, it is affecting the routine or it is affecting the operating of the company also, then definitely it is going towards the going concern matter. Then how to report is that if the company has support plans, if the company has some support letter, if it has projections and things like that, which we discussed very much in detail, then that can be something that actually you can put it, and then there can be material uncertainty para in the audit report. And then you can say our opinion is not modified to this effect. And similar reporting in CARO also, because CARO also requires you to report on going concern. So there is one point that I would like to, highlight here. There are a number of cases where the CARO reporting and the main reporting do not match. So in CARO there will be a going concern issue, and in the main report it will not be there. So please take care of that also. And if at all, in the given case, if at all the cash crunch is so heavy and it is a standalone company, there is nothing else to support that company largely, then it will have to be a qualification or adverse opinion, as the case may be.
Then the next question is how to determine going concern assumption being fulfilled in case of project office of a foreign company that is operating in India in case the project period is say 2 years.
Yeah. Yeah, this is a very typical question which we often get. So, if the project period itself is 2 years, so whether it will be able to complete its project is most important. Then that has to be brought out as a disclosure in the financial statements, in the notes to accounts, and then we will have to further look at as to what is it that we need to do it in this case. Because if it is not able to, so I think foreign project companies or finance funded by the foreign company, So there will be very minimal operations that will be undertaken in the given case, is what I understand largely. So if that is the case, then that will be, that will be a specific reporting in terms of that. And then there can be a note to that effect in the financial statements. And then attention is drawn to that, saying that this company is existing only for this period. And accordingly, we have looked at the relevant matters over here. So that can be a specific UM. It's not necessarily a going concern matter in the given case, because that is where it is not going to be existing after the completion of the project period. I think that you will highlight in the basis of accounting as well as the accounting code.
Okay. Now, in the next question, the member asked that in case of ongoing legal cases directly affecting the working of the company, but which are being contested strongly by the company and have good probability of favorable outcome. However, due to long time being elapsed in the settlement of legal cases, auditors are skeptical on accepting going concern position of the management. So, how to address this position for the auditors?
Yeah. So on periodic basis, for example, year on year, you have to get the PPR analysis or the possible probable remote analysis by the respective lawyer who is doing, or who is fighting the case for the company. And if the matter is quite large, impacting the financial statements as a whole, then the auditor himself, if he is competent to, for example, income tax or other cases, you may be competent to. But if it is a lawsuit, legal suit in terms of other business matters, maybe you will have to use an expert to actually evaluate what the other lawyer is saying is making sense, or it is just too much in the air. And then accordingly decide whether it is an impact on the material uncertainty or otherwise. Because say for example, if the size of the company, or if the balance sheet size of the company is 500 CR and there is a case that is outstanding to the tune of 700 CR, it definitely makes you think twice before signing the financials. So therein you will have to put an expert if required to get the assessment done and do a decision. And year on year, whether even irrespective of whether it is done in the previous year and there is no hearing or no changes, you still have to do a PPR analysis, because there may be similar judgments in some other courts which may affect this judgment. So that analysis will have to be done and that has to be preserved. And based on that, you can take the decision.
Okay. Ma'am, in the next question, the member asked that are there any different way of establishing the going concern? Like example, considering a legal entity as a single CCU and assessing the enterprise value based on discounted cash flows. And second example is considering a 12-month projection and subsequent event.
Sorry, can you read it again? In between, it was just a network issue. Sorry.
Okay. Are there any different way of establishing the going concern? Like for
Okay.
example, considering a legal entity as a single CCU and assessing the enterprise value based on discounted cash flow. And second example is like considering on 12-month projection and subsequent event.
Okay.
Any?
Yeah, understood. So you're talking about the enterprise value versus the cash flows assessment for the 12 months. So first of all, the onus on the management is to actually prove that the entity will be in existence or it will not have any issue. In other words, for the 12 months from the date on which the financial statement is getting closed, that is the financial statement closure date or the end financial period date. Not the closure date, sorry, end financial period date. If largely the financial forecasting, if there are any material uncertainty problems, the financial forecasting is something that will largely help, because what is that after 12 months that you will look at is more important rather than the enterprise value as of today. Because when you get a valuation done, it is more of a valuation as of today, which will say that this is the value of your entity. It doesn't actually give a comfort on what it will be in future. But when you are looking at a material uncertainty para, you will have to look at how you will be in future. So you have this value plus what are the things that you will be doing because you have some problems. That is why I'm asking you this question. So what is it that you will look like after 12 months is very, very important. So I think future cash flow projections and evaluating those, vetting those future cash flow projections will become very important in my view.
Ma'am, this question is in continuation of the earlier question regarding IBC. If a qualified opinion is given and figures are given on realization or liquidation basis, there may be chance to receive lower valuation from the expected buyer.
There is a very important aspect of what is our duty as auditor. Management, so let us not step into the shoes of the management and the company because yes, we look at, sometimes we look at solutions for the business, but then that should not at any point in time override what is our duty. So we have to actually be speaking the truth and we have to qualify, and it will be in our purview as well as our responsibility to do the right reporting, irrespective of the fact that it is going to give a lesser value to the buyer or the seller, or as the case may be, or it will give a better bargaining power to someone else. Because as per auditing standard, I have to go as an auditor, I have to go as per auditing standard, and if I'm going as per auditing standard, this is what the auditing standard telling me to do. Because the company has already gone into IBC, I am not sure how the NCLT is going to decide on this case. It can ask all the assets to be sold off. It can go for a resolution plan. It can change the management. So multiple options available here. So in the given case and in the given uncertainty, and these processes generally take a couple of years. In terms of these uncertainties, I think we should do what is our duty and we should do the qualification with respect to those matters, is my view.
Okay. In the next question, member asks if any organization is fully dependent on holding company or funds, then how to check going concern?
Yeah, so I gave this example when we spoke about this thing. So if it is a wholly owned subsidiary and if it is fully dependent on the holding company for all its operations, it's getting funding, it's getting operations through the holding company. So any going concern matter also, the holding company will support. So then you not only check the material uncertainty related matters of this company, but also of the holding company, because holding company is completely supporting. So they have to be, they have to be a proper going concern entity, and they should not be having losses, negative net worths, indicators, non-financial indicators, nothing of that sort. So it will be necessary for you to go through the balance sheet of the holding company also and look at the health of the financial health of that company.
Ma'am, the next question is, a company has been incorporated about 2 years ago and it is a BPO company. However, due to the adverse contract with the foreign companies, the company is incurring heavy losses and funded by loans from shareholder. Is it a going concern or not?
Seems to be so because it's already cash bleeding is happening. There are heavy losses. I think there are some adverse contract with the foreign companies, what I understood. So that means the cost plus markup is not properly done of that company, or the pricing is not done of the company, and they are having loans from the shareholders also, is what it is mentioned. So I think it is already heading towards disaster, is what I can see from the facts that are given.
Okay. Ma'am, the next question is, the company is a new startup company. Since 3 years before it got incorporated and no operation till date. And it is supported by shareholder for rental, audit fee and ROC fees. Because it is still developing the website for its business like Amazon, Flipkart. So ma'am, whether there is a going concern or not, ma'am?
Yeah, in
It
case of
is a going
startup
concern.
companies, as I mentioned, there are two schools of thought that exist. Conservative thought is there is a going concern issue here because the company is still not standing on its feet. But the another school of thought that exists is that there is a gestation period, which may be a couple of years. Until that time, you give a proper disclosure in the notes to accounts, and MUGC para is also given to that effect. So I think that would be a balanced view.
Okay. Ma'am, in next question, what are the role of auditor in case of previous financials were prepared under not going concern basis due to the concern reasons which have now been reverted and no longer exist? So, can the company prepare the next financial under going concern? And in case auditor are satisfied, do they still have to report or put an EOM para for changes in the position in current year?
Yeah, I think interesting question. This happened a couple of times in the times of COVID. So there were many companies where there were MUGC para during the COVID period, if you see, and few of them prepared the financial statements on realizable basis also because they did not have the funding, they did not have adequate, capacity to keep going. I think after 3 years, the businesses started getting revived, and some of them actually came back to good health and the pink of their health. So I think in those cases, the no going concern or the realization basis actually got converted into a normal one. And then to actually specify that the company has done this, I think a couple of auditors have given EOM also, but I think a couple of them haven't given. So I think again it's a judgmental call as to personal view or my view is that there has to be a proper disclosure in the notes to accounts. Attention can be drawn in the financials because it's a major change. It has to get to the notice of the readers of the financial statements or users of the financial statements, which is very necessary. Accordingly, because it is liquidation to no going concern basis, there may be a lot of accounting policy changes, and there can be a lot of depending on what is the financial reporting framework, Ind AS or whatever other framework, there can be a lot of accounting implications also. So all these to be taken, and then because this is a quite a large change, you may have to give a emphasis of matter in terms of drawing attention of the users that this has changed significantly.
Ma'am, it is the last question. And is negative cash flow always considered as a confirmed indication that a company is not a going concern?
Negative cash flow. So, continuous negative cash flow, there are obviously the operating loss as well as the negative cash flow. So a continuous negative cash flow, which is going towards operating losses and coupled with other indicators is seen as that's the first trigger, I would say. Negative cash flow may be a first trigger. Then I think the next stage of losses may be the first trigger and negative cash flows followed. So it is interchangeable. Then third thing goes into negative net worth. So any of these gets into something negative, you have to always keep an eye open. So it cannot be the only thing, or it cannot be the definitive thing that this is the only trigger, but we will have to always keep a watch on these main things: that loss of business, loss of any major customer, any major buyer, seller, retrenchment of employees, and this negative cash flow, P&L being loss being made, and negative net worth. All these things are so critical that once any of these trigger, we have to keep our eyes and ears much more open and be more vigilant in all these cases.
Okay. Ma'am, in case of consolidated financials showing losses and negative net worth due to losses of the subsidiary, how should this situation be addressed by the auditor of holding company for both standalone financial statement and consolidated financial statement?
Yeah. So in standalone financial statements, or whatever, assuming Ind AS as the case may be, the investments are actually valued at fair value or the historical value. So when you have the investments being valued, there the losses, when there is losses in the subsidiaries, the investment in the subsidiaries have to be impaired accordingly because there is an impairment indicator there. That is one side of it. I'm not getting into more details of accounting here, but trying to assess from the overall. Now, if it is a company which actually is only having holdings of multiple, it's like a holding company which is actually just investing, then if substantial portion gets eroded, there can be a question mark on the going concern of the holding company. Another side of seeing it is that if on a group basis, even if there are losses in the subsidiary, and those subsidiaries also I am supporting, I took this as an example while we spoke, and so you have to evaluate the going concern of the group as a whole. So as group as a whole, me plus 4 subsidiaries, 2 associates, 3 JVs, whether I am able to stand on my own feet. So going concern has to be evaluated at my end. And then the subsidiaries that I'm supporting, I have to see that whether I have adequate amount to support those subsidiaries, or if I'm just, making a assumption that I'm able to support, and then later on going forward, then I'll say I'm not able to support, something like that. So that is something that has to be a proper assessment that has to be done. So group level assessment, there are 2-3 paras in SA 570 which talks about assessment of the going concern at the group level.
Okay. Ma'am, thank you, ma'am. All questions are covered.
Great. Thank you.
Ma'am,
Thanks to
once
all the
again,
participants.
sorry, ma'am.
Thanks to all the participants for patient
Yes,
hearing.
ma'am, we also thank you to taking time out of your busy schedule to guide us on this topic, ma'am. And we also thank you for all the participants to join us. Thank you, ma'am.
Thank you so much.
ठीक है अब बंद कर